Two stocks I own with massive upside potential. This is an amazing day to talk about those stocks as the market is red. Even my short is red because I'm down a lot on those stocks and they've been going down recently. So I'm going to talk about them. And this is a good time again to look into the growth stocks, in my opinion. I buy the growth stocks whenever the market's going down. They're down 10, 20, 50, 60%, high beta stocks. But those are the stocks that do best whenever the market recovers. It's just not as easy to buy them whenever they're going down. But whenever it's not easy to buy something, it's normally the best time to be buying something in general. The first one is Hims and Hers Health. It's down 34% over the last months, and people again are doubting the stock and they're kind of crying about it a little bit. But to me, I've been in the stock from $7 per share, and people told me, I wish I bought Hims at 7. Yeah, maybe you did, but would you have been able to hold through 3 or 4 or 5 50% plus pullbacks? We've had a 45% one, 55%, 49%, 66%. This other 48% one. To me, it's nothing. The only way I was able to hold from $7 is because I was not paying attention to the chart. I was paying attention to the fundamentals, to the long-term thesis around the company. It's easier said than done. Most investors can't do it. But this is why investing is hard. This is why investing is not easy. And people find this out whenever the market is going down. But I've been, doing this for a while, and Hims is a little bit of a dramatic stock. Like, this is when it went to $14 in 2024. $14, guys. And people were saying that they are assessing the risks. This is what people do. They look at the risks when the stock is going down. When it's going up, they only look at how much more it could go up. And if you do the opposite, you'll be fine. I said people loved it just a few months ago. Now they are assessing the risks only after the stock has gone down. Then they get excited about it once it goes up. Do the opposite and you'll be fine. This is, again, how the market works. And I'm personally doing it again. And Hims at this price could be Hims at 14 back in 2024 when people didn't want to touch it. But in terms of why it's going down, and maybe it's because of the market in general, but very recently, Eli Lilly and NVO have signed a deal with the government to lower the prices on a lot of their drugs. And for their injectables, it's going to be $350, and it will trend down to $245 per month over a 2-year period, but it will be around $350. Now, Hims' own compounded GLP-1 is around $199 per month. It's cheaper, and Hims can take it all the way down to $150. They have done it before. So on a pricing range, it could affect the business, but not as much because the Hims one is still cheaper. And for a lot of people, $150 a month difference, it kind of makes a big deal. But what's really going to hurt Hims, in my opinion, is the oral GLP-1 pill that Eli Lilly and NVO are coming up with. And they said it will be at $149 per month for everyone getting them through Medicare. This is very competitive. But it says the starting dose of upcoming obesity pill. So this is the starting dose. What about what's after the starting dose? So this is a tricky word that I don't know how I'm going to have to explain it. I'm going to have to wait and see what happens. But 149 is a real risk for the company. The company has their own oral pills for $69 a month. But again, oral GLP-1s for $150. If this is sustainable, it's really going to hurt the Hims and Hers business model in general. But Hims and Hers is not just an oral, or it's not just a weight loss company in general. It is maybe right now, I believe around 20 or 25% is in weight loss, but the company is diversifying away from it. Just like Amazon was Amazon, then Amazon Web Services came in and other things came in. This is what Hims is doing in healthcare. Now the Hers business for women is serving more than 500,000 women today and is on track to deliver over $1 billion in revenues next year. So this is almost 50% of the revenue is for the Hers business for women, and most of it is not through weight loss. Menopause is a big one for the Hims and Hers business. So the company is diversifying. The company is entering Canada in 2026. Now they only have the weight loss solution where they sell generic GLP-1 because NVO did not renew the license, but they're going to expand more in sexual health, dermatology, mental health, hormone longevity. Those are $100 billion, $200 billion total addressable markets each. And do you really believe that Hims is going to be a weight loss company forever? I don't think so. The company is diversifying from it. And I think once it does, it will get a massive multiple expansion. Now, very recently, the company has launched something called lab testing. This is how lab testing work. It just came off today, where you could test yourself as at Quest Diagnostics, I believe. And through the HIMS app, you can track your health and track a lot of different things. And then they have an action plan where if something is not too good with your health, like metabolic health, HIMS can give you their solutions from the HIMS and Hers platform so they can cross-sell you their products and they can keep you within the ecosystem. This is a game changer in my opinion because it's going to make the HIMS and Hers subscription more sticky. And they also have something called biological age, where this is like an age based on the health assessment of the lab testing. And they give you the difference between your biological age and your actual age. And if you're younger on your biological age, they would tell you that, you're like aging slower and this is good. But if you're aging faster, then this is what you need to do. And you have to kind of purchase it from the HIMS and Hers ecosystem. I think this is an amazing product. To me, it's very competitive. It's only priced at $200 per year. Most of their competitors are at $300 and $350, and they don't have an all-in plan solution. So they give you your test, the results, but they don't have the products or the medications for you to improve those results. HIMS has everything all in one, and I still believe this is ultimately going to be a game changer for the company in general. But the company is still growing. They grew subscribers 21%. Average revenue per subscriber grew at 19%. So this is a very healthy metric. The company, if you add their cash and cash, short-term investment, and long-term investment, they have about $1.1 billion of cash. And the market cap is $8 billion. So this is almost 20% of the market cap, guys, is in cash. And this is, they have a lot of optionality to buy back stock. If it gets too cheap to ignore, they have done it. They could do it again. They can do acquisitions and expand their revenues in a major way. They could do so many things with $1.1 billion in cash for an $8 billion company. Now, in terms of the upside potential, the company is still confident, and they said our conviction remains high in the 2030 target of $6.5 billion in revenues. Now, the company is trading about 3 times sales, so 3 times revenue. I don't know about you, but 3 times revenue is really cheap for a company that's growing revenues 50 to 60%, and they will likely continue growing revenues 20 to 30% for many years to come. It's mainly trading at such a low multiple due to the potential NVO lawsuit, which hasn't happened yet. And if it wanted to happen, it would have happened by now. That's my opinion. And the second reason is due to the reliance on the weight loss business, which is more competitive than other areas of the HIMS and Hers business. But as I told you, HIMS is diversifying away from it, and the home lab testing is going to make it more of a sticky subscription, so the churn rate should come down. And I believe such a company should be trading between 5 to 7 times sales, in my personal opinion. Now, the way I would value HIMS is the way I pretty much always do it. And I take the current, I should say the expected revenue figure of $6.5 billion, and I take 6.5, and I either use 5 times sales or 10 times sales. I think 5 times sales is a little bit conservative, but it's the most likely outcome. And if it gets to 5 times sales, 5 years from now, this is a $32 billion market cap. The current market cap is about $8.5 billion. This is around 300% on the upside over the next 5 years with 5 times sales. If you use 10 times sales, this is a $65 billion market cap, and the current market cap is $8.5 billion. So this is around 664% on the upside over the next 5 years with a company like HIMS. And this is, again, I believe, a conservative target for $6.5 billion in revenues, as they still have the cash position, which they can do acquisitions and grow revenues immediately and earnings per share in general. So to me, I still believe HIMS is an undervalued opportunity. It's too cheap to ignore, and there's a lot of drama around this one where the stock goes down and everyone gives up on it. And then once it goes up and it has those magnificent rallies out of nowhere, people they say, I wish I bought more, and I wish I did this, and I wish I did that. Maybe I'm wrong about the business, but looking at the numbers, I'm just not seeing how or why HIMS deserves to go down 50 or 60%. But this is what happens with the stock, and it's really, really volatile. Now, the second one, which I own, that's also been a disaster recently, is Ouster, and I'm going to talk about it here. Alstor stock is down 26% on the months. It's been a terrible performance from the company. Now, the reason why I owned Alstor is because I want to bet on robotics in general. And most robotics, like this one from Serve Robotics that delivers food, uses Alstor LiDAR sensors. So all those robots, pretty much, they need sensors to operate. They are the eyes of AI. And Alstor is the leader in this market, in my opinion. And this is a $14 billion market for Alstor in general. They also have the industrial segment where a lot of forklifts and heavy equipments, as you can see here, they use LiDAR sensors. This is an $18 billion TAM, as I believe automation in general is a major trend, as we have a lot of things happening with immigration, but we also have reshoring coming to the US. So the only solution is automation, and most of them need LiDAR sensors, and Alstor is a leader in the industrial automation. Now, they're also in the automotive segment, robo-taxis and others. They don't have a massive exposure. They are just entering the automotive space. The company is well known to be focused mostly on industrial and robotics in general. They have a technological edge in this area, and it's less competitive than the automotive sector, where you have Innoviz and many of those companies trying to compete for every dollar and every penny. There's not much competition in the industrial space and robotics, which is why Alstor is mainly focused on this area. Now, the most exciting part about the business is the smart infrastructure. So the infrastructure in the United States is old, but especially traffic monitoring systems are very old. And a lot of the traffic monitoring systems right now are being replaced by Alstor LiDAR sensors. And this is over a $19 billion TAM for the company. All in total, it's almost $100 billion in TAM, and the company is $1 billion, making $140 million in revenues. So there's a lot of potential here. But the main reason why I love this business, and it's not only a hardware business, but it's also a software business where you need the Alstor software for you to be able to monitor the traffic. So this is going to allow the company to become more of a software company over time, and it's going to allow them to expand their margins, which is why Alstor has about a 42% gross margin, and it's been increasing over time. This is one, because of the software business, but two, because they have a technological edge in robotics and in industrial automation. So this is why they have higher margins. If that was a competitive business, they would have 5, 10, 15% gross margins. But the company is putting up 42% gross margins, and I believe that speaks volume. Now, for the latest report, and this is the part that upset a lot of investors, is the report was amazing. Everything you could want from a growth company in its early stage. Revenues went up 41% year on year, 13% quarter on quarter. The growth is absolutely insane. GAAP gross margins of 42%, up 400 basis points year over year, which is really, really good. Net loss was 22 million, an improvement of 4 million year on year, and 1 million quarter on quarter. So this is everything you want from a growth company. You want a good balance sheet, you want revenues increasing year on year, quarter on quarter, and you want net loss to be going down as it's heading for profitability. The company put all those numbers up, but the stock is down 35%. And this is, again, it's a little bit frustrating to many investors, and maybe a little bit to myself also. But this is what you have to know about those, growth companies in general. Like, if the market is down 1%, they're going to be down 10, 15%, even though the company itself did really well, which is why I try to focus on the numbers and the business model in general versus trying to cry and worry a lot about, price action. I bought many stocks, like even SoFi in February, and it went down 45% after. I had many stocks that have down 50, 60%, and they recovered, and they were one of my best winners. So I'm not going to let such short-term price action dictate my thesis about the company. But the company has about $244 million in cash for a $1.3 billion market cap. This is a really good cash position. Almost 20% of the cash position of the market cap is in cash. Now, for losses, the company is still losing money, but on an earnings per share basis, it's massively improving those losses. It was losing 71 cents in December of 2023, then 55, 53, 46, 42, 38, 37, and they're expected to only lose 14% next quarter. So the company is losing less and less money over time. This is a trend that you want to see in a speculative growth stock in general, and it's improving, and I'm very happy to see that. And I believe they will likely be profitable by Q1 of 2027. Now, the biggest problem with this company is they're diluting stock like crazy. Like shares outstanding are going up about 2 million a quarter on average, and that's really killing shareholders in general. But this is what the company is doing as it's in its early stage of the business cycles. They need money, not just to cover the losses. They're gonna be profitable soon. It's not mainly for losses, but they want to have a good balance sheet to show their suppliers that they are a reliable company, that they have cash on the balance sheet. And they also maybe want to do some acquisitions as the market is going down. And they have the liquidity position to potentially do that. So I'm hoping dilution slows down over time as the company becomes profitable. This is what happened with SoFi and Palantir and others. Once they turn profitable, dilution goes down. And I believe the same thing will likely happen with Outstore. Now, one reason why I believe the stock has kind of overreacted to the downside is because we are awaiting the Kronos launch from Outstore, which is supposed to more than double the current total addressable market. This is going to be a game changer for the stock, the new generation product for Outstore. But that was supposed to be launched by like mid 2025, and they still haven't done it yet. And they said that they're going to launch it as soon as humanly possible. So I believe the market is running out of patience with the stock. And, the management has a history of not delivering on such releases. It always takes a little bit more time. But I personally don't mind if it takes more time as the core business is growing and the company maybe is trying to do it right than just rushing to finish it as soon as possible. So I'm not too upset about it, but I think the market is, and that's why the stock could be going down. Now, in terms of revenue growth, the company is guiding 30 to 50% annual revenue growth from now to 2025, 2030, 2035. They haven't put in a range in terms of the date on it, like an expiry date. But I look at the business, I'm seeing over 100 billion in total addressable market, and they only make 140 million in revenues. So I could easily see the company growing 30, 35% for the next, 5, 10, 15 years. I think this is highly, highly achievable. And the stock right now is trading about 7 times enterprise value to sales. 7 times for a company that's early on in the industrial automation, which is a huge trend, and it's growing 30 to 50% revenues, accelerating, 41% gross margins. I don't believe 6 or 7 times sales is too expensive for a company like Outstore, and I'm seeing massive potential on this one, and I shared the upside in another video, which I'm gonna put the link over here. But nothing has changed with my thesis on Outstore. I'm still holding it for the long term as a small speculative investment. It's a small percentage of my portfolio, and I'm gonna hold it for the next 5, 10 years, and I'm gonna keep it and see what happens as long as the thesis remains intact, as long as the company is delivering. I don't see a reason to sell a stock just because it has gone down. So that's my opinion on Outstore and HIMS. Hope you enjoyed it. It was not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.